what is a large pension plan to do, right? Okay, so we've addressed how chasing an anomaly with too much money can invert it. And here you are, you're a large public pension plan with the billions of dollars, and you're faced with a reality of the academic work and some of these premiums that have existed in situ. And then you're faced with a massive amount of money that you need to deploy. How do you attack that problem? I have an answer, but what is the best and only way to attack that problem?
I think it comes down to whether you can get comfortable with the experimental design of the firm that you are engaged with as a prospective investor, right? And I mean, part of this is that institutions, in some ways, are the authors of their own frictions here, because we know many firms, like some in Canada, for example, that openly tell you in advance, whatever you tell me at this meeting, we're going to turn around and use internally. We're going to steal all your IP. And so, don't buyer beware or seller beware, I guess, in this case, right? And I think one of the things that Swensen did really, really well, and this may actually be the primary source of Yale's edge, was that Swensen partnered with funds as an equity investor for essentially forever.
With the mind, with the head guy. Yeah,
exactly.
I remember this. That's right. Exactly. With the brilliant mind that would be able to find unique edges for the rest of his life. And I want to partner up with you until the day.
And the big reason why there's obviously like alignment of incentives, but the real reason why alignment of incentives is so important is because it allows the manager to open his kimono. Because what really matters is the process. The returns are bullshit. Like over time horizons that anybody cares about, the returns don't tell you anything. Sadly, that is the truth. What matters is the process and the experimental design that gives you the confidence, sufficient confidence, enough data over enough market environments that where this particular approach sustained its edge out a sample that allows you to get comfortable that there might be something there. And if I'm an institution, I might really buy into this guy's process and this guy's experimental design, this guy's methodology, and this guy's edge. But I still want to spread my bets around, right? I still want to have a dozen or 24 managers in different fields with different points of view who are attacking the problem in slightly different ways. Or some of them are going to be just off base. Others are going to be, are going to get it right. And on average, if you've got conviction and invested in partnerships with your managers and you're going to stick through it through thick and thin, then you've got a shot.
Well, this idea that you can buy factors now out of the can from a swap at a big bank, you're buying some brilliant mind's old idea. It's obsolete the moment you buy it canned, right? Mm-hmm. What you should be looking for is the manager or the management team that proves to have a process to continue to discover those edges wherever they may come. And we've moved away from that because I don't need these obscure, brilliant managers that I need to do a lot of work for. The academics that done the work for me, I can just buy that from Credit Suisse as a swap.
Yeah, and that show's over, right? It's demonstrably over. You just got to look at any composite factor indices. That's over. Yeah. If it ever existed, it doesn't exist now.
That's something that actually we were having a chat and the function of the board managing whatever the endowment is not necessarily a profit maximization function. It is in some cases in the endowments, in some very thoughtful Yale-like endowments. Bowdoin's endowment has very aggressive. Notre Dame's probably another one, very, very thoughtful input. But in many cases, that's simply not the case. So it's OPM, and the function of the board seems to be more one of cover your ass and best practices. Well, by definition, best practices means the most common practices used or most pervasive thought processes used across all endowments, which then leads to, well, I need some factors because everybody has some factors. How do I do that inexpensively? And so the system itself is a bit flawed in the way at which it sort of fosters the management of this money. What's the objective, right? Just give me the objective function, and then we can go from there. And so that's a really tough problem to solve. And there's a lot of thoughtful, if we think about university endowments anyway, there's a lot of thoughtful university endowments who have done a great job. And then there's ones
but
who
I think
are
they've solved it. And I think you said several of them who've solved it, and they solved it by making clear that their allocations are permanent capital, right? I'm committed to you. We're in this together, and therefore you can open your kimono. I can get familiar with the fundamental principles of your thinking, and therefore, and I know that's the only way that I can ever have a good sense of whether you've got something or not. And even then, I'm still going to get it wrong a lot of times, right? But literally the only way you can do it is a commitment from permanent capital. Otherwise, maybe you've got good relationships and you trust people and what have you. That requires a different level of faith, which I think is meaningful, right? But still, if you're an institution and you have the ability to make a commitment to a team or to an individual that you believe in, that I think is the only way to really have a sustainable edge.
Mike, what was it? Was it Fairfax Financial? Is it Fairfax Financial, the one that's this individual that's similar, like completely orthogonal thinker?
Oh,
CIO.
Chu. So Francis Chu works for Fairfax, and he has some Chu funds in Canada.
Was that it? Anyway, like the returns.
Maybe, I'm not sure.
I think it's at one of these funds. The returns were phenomenal, but when you ask like, how does the committee make decisions? No, the committee made a decision that whatever he says goes. Right? It was like you have all the power.
Yeah, Prem Watsa. So if you have a patron who owns so there are lots of endowments for universities that have some pretty significant wealth tied to them. And then they will have some involvement from those folks. And sometimes those folks run pretty significant private equity or hedge fund type environments, and they make pretty substantial donations. And they don't take that lightly, as in they have a way in which they think about the problem, and they sort of dictate to the endowment that there will be some unique thought put in place in order to they apply their influence, if you will. And so in those cases, you tend to see probably some more unique performances, right? Some unique.
And you take the crazy thing about this and the way our society is structured is that you take an immense amount of personal risk. And I know we talked about this before, but I want to talk it in the sense of like legal risk, right? When I started in the industry, I started smiling and dialing because I only, I was an immigrant, didn't know anybody. I had these ideas, these quantitative models that I wanted to deploy. So I started talking to people. I was in the wealth side of things. And as I got to learn more about the legalities behind what are my risks as the CIO of my wealth book, what it was, if something went wrong, right, with my quantitative models and the completely different, long, short, it was all alternative based. There was no basic beta. It was wild portfolio construction that nobody was doing at the time. I remember losing sleep at night when somebody told me that the way you're going to be treated in court is they would put other financial professionals in the stand and ask, would a reasonable professional in your shoes have done what you did? And I knew the answer was going to be categorically no, and I was going to be sued, and my career was going to be over. All right? It didn't stop me from being a misfit and doing what I wanted to do and the right thing for clients, and it paid off, thank God. But it was a constant fear. Why I decided to take that risk, I don't know. Why I continue to decide to take that we all as a group and found my people here, we don't know. We're just built differently, right? But you require that level of irreverence to be able to succeed in this world. It is, right? And at the level, and right now, you're not dealing with, like, there isn't a public board that's beneath us. When you're at that level, when you're like, I can imagine Swenson, all the pain that he's had to go through and the personal risk that he went through to do what he did. That's unfathomable.
Well, Swenson is documented in his books about his success being handpicking the investment board in order that they be able to make decisions that are in congruence with his
Then
vision.
the board's out of their mind, right? The
Well,
board's out of their mind.
Yeah, again, I think they're visionaries. I think that it's, to some degree, we're treading in some waters that we have not lived in for a decade or two. So I do want to sort of say also that I do feel for all of those who are employed in managing assets at endowments and fiduciaries and things like that. I really feel for you, and I feel for the conflict that's there. And so,
especially in the current paradigm, right, Mike? Because we've seen, I mean, this may be again anecdotal, but some of the evidence would point to this as well, that a lot of the factor desks in these big endowments have been dismantled.
Mm-hmm.
Investors in general that had relied to varying degrees on these factors for performance have cried uncle, right? They've thrown in the towel. It's too much pain. They can't do. So you guys are proposing that they partner up with these asset managers for permanent capital. But the fact of the matter is, in this current paradigm, we are witnessing a sort of break in the credibility of all these, of several of these strategies.
Well, are we observing a revelation of the fallacy of construction that was there to begin with? I think some of us are waking from a long dream, that there was this dream that was you could publish a white paper and gain confidence from purely in sample data and launch a product and not have to worry about other people discovering it and crowding and overgrazing and inverting the premium, right? There was a dream that was...
That's an important distinction. Yeah, I'll grant you that. But what is one then to do if most of the actively managed capital out there is still being managed to some degree under this guise?
Well, actually, I think it's harder than that even, because, I mean, the reality is any effort to diversify away from US 60/40 over the last 10 years has been just an excruciating, grinding pit of despair. Right? I mean, we just recently ran an analysis, prompted as usual by a thoughtful prospect, wondering why most of these multi-asset funds have done so poorly relative to 60/40 over the last decade. And so we just ran some random portfolios. So we've got 17 equity futures markets and 10 bond futures markets. And we're going to hold the weight of equities at 60% and bonds at 40%, but we're going to vary the allocation in the equity sleeve across all these markets randomly. We're going to vary the allocations in the bond sleeve across the randomly. And what we observe is that the performance of the ES and TY, so the S&P 500 and the 10-year Treasury futures over the last 10 years, were above the 92nd percentile across all of these random potential portfolios, which is to say that you had to be really, really smart.
How about the NASDAQ? How about
really,
if you change?
Yeah, the NASDAQ was literally the choice of NASDAQ 60/40 with treasuries was a 1 in 10,000 outcome. So, you had to be just unbelievably so skilled it's really not even possible to have had at your disposal an opportunity to invest across all of these different markets 10 years ago and chosen US 60/40 as your go-to and stuck with it over that full 10-year period. And so that's a really general explanation for why most multi-asset funds who prioritize diversification first and foremost and have the opportunity to go invest in Europe and Asia and Japan and commodities and other bond markets and in other currencies have suffered so badly versus US 60/40. And further
what we're seeing,
diversification spectrum, the worse it gets.
What we're seeing actually, Richard, I think you've seen it with me, is a retrenchment away from the quantitative, well-researched active management, and saying, well, I don't know anymore, so I'm going to go back to basics. I'm going to go to passive.
That's exactly right. That's right.
And because they're retrenching to beta, they're like, well, how should we think about beta? And I'm telling you, risk parity is going to be the thing over the next decade, right? That may be where everybody's like, okay, I believe in the equity risk premium, and we're just going to do it in balance, and we're going to start there. And then when they realize that bonds are expensive and equity is expensive, it may not be enough, they're going to start to wade back into. This is wild speculation, by the way.
Sounds like a prediction. It does sound like a prediction.
And then you're going to have to, because it's always an ebb and flow, right? So we flow too much towards one end, forget about all the discretionary managers. We're going to go through this process. Oh, I can replicate that from white paper. I'm going to fire everybody. I'm going to do my active management. Oh, that didn't work. Let's go back, retrench from to beta, possibly a better beta. But they're going to go back into the active space with a whole new mindset. Like they're going to have to, because there will be exploration into why that didn't work. And there might be some discretionary managers that are really thoughtful thinkers and have this fantastic way of understanding flows in the market and connections with trade desks around the world, and they can do that. And there might be these other quants like us where we're looking at the experimental design completely different, so that we don't fall into the same pitfalls that the traditional factor-based management does. I think, it's just from understanding ebb and flow of this market.
Well, here's what we know fundamentally to be true, that the stock market will peak when the very last person abandons their efforts at diversification and invests in U.S. equities. Right? That is the very moment when the stock market will peak. And we're already seeing we're getting lots of inquiries and seeing lots of comments about, why bother with diversification, and, nothing works but U.S. equities, or why would you bother? These are people who are capitulating to, it's too painful to be different from the crowd. And I forget who was it that said, there's nothing more painful than watching your neighbor make money, or something like that. I'm butchering that quote, but this is the phenomenon that
I think it's not enough to make money, but you have to see your neighbor fail.
Yeah, right. That's another.
That's a Mike Philbrick quote, I think.
Schadenfreude. No, I don't know.
Yeah.
Maybe it's a good
But
point.
well, definitely, it's very hard right now for investors it's been hard all along. It's harder than ever right now at this moment for investors to look beyond U.S. equities. And what that probably means is that it's rarely been more useful to look beyond U.S. equities. And this is not a market timing call at all. I can certainly sympathize with Mike Green's arguments and others about the just relentless flow of savings into the S&P. So I can buy that to some certain extent, and Corey's paper, et cetera. But I do think you still got to spread your bets.
Yeah, look, I think a good quote to end with is a favorite of mine from supposedly Mark Twain. We'll see. Which is, whenever you find yourself on the side of the majority, it's time to pause and reflect. That really is some words to live by. All right.
Hashtag wisdom.
Yeah.
All right.
With that, we're at an hour and a half, gentlemen. Any other final thoughts?
No, I think that was good.
Well, all of this is counterintuitive. What I want to know is, when do you make the leap of counterintuitive being intuition? Anyway.
Turtles. Okay.
I like it. That is, we should cut it right there.
All right, Jeff.
There you go. You've seeded the conversation for Poker Night.
That's right.
All right. Thanks for listening, guys.
Thanks all. Thanks. This was fun.